The information in this podcast is general information and not advice. Stanford Financial is authorised under Australian Credit Licence Number 541480. Further information is available at stanfordfinancial.net.
Hello and welcome to On the Couch with Steve, a podcast where we help you navigate the often complex world of buying, selling and renting real estate here in Ipswich. I'm Steve Athanates. I'm the owner of NG Real Estate Ipswich. I'm joined today by Steve Beach from Stanford Financial. Thanks for coming along, Stephen. How are you?
We're very good and absolute pleasure to be back again.
Lovely. So obviously today is the 1st of August and we're talking all things interest rates.
Definitely.
So, mate, without any further ado, what happened with interest rates?
So we've got good news again. They have decided to keep rates on hold. So the cash rate,
yes, that's very good.
does remain at 4.1%. So I guess from the lows in COVID where we saw 0.1%, we're still sitting at a 4% rate rise since then. So.
Okay, so now we both we thought interest rates would go up.
I 100% thought
they were
going to go up until probably about a week ago was when we started seeing some of the information that's come through for the RBA to make some of those informed decisions. So we started seeing inflation rates like the GDP and everything along those lines. Won't go in too technical, but I guess a big predetermining factor is the whole reason why we lift interest rates or the cash rate is to stem inflation, to stop consumer spending.
Yeah.
So everything doesn't continually to go up. So cost of fuel and bread and importantly rent, which has been, I guess, a big target for a lot of people. We did actually see the predicted, inflation rate was at 6.2% for the end of July, and it came in at 6%. So,
well, that's good. That's positive.
So we're heading definitely in the right direction. So unemployment still actually remains at all-time low, but they're not as concerned about that as once they were before.
Were we talking last episode about the fact that 130,000 people needed to lose their job?
They're still predicting that, but their anticipation at the moment is we're currently sitting at an unemployment rate of 3.5%, and it needs to be somewhere around about 4.5%. So, but they're not anticipating that until probably this time next year. So it's there's still a lot more people actually getting jobs than people are losing jobs. So, so it's actually in a positive light, but what everybody's feeling out there at the moment is the cash crunch and surplus cash. Consumer spending has reduced greatly. The amount of actually holding deposits in Australia has dropped substantially as well, and a lot of that's to do with people with offset accounts and stuff like that have had this surplus money through COVID. Prior to COVID, there was a lot of money, but $750 billion in cash reserves in Australia. Across everyone's bank accounts.
Yes.
It went up to $1 trillion through COVID. So a lot of people sort of, I guess, held money back. I think a lot of that was contributed towards where people took their super out as well.
Yes.
Sort of influxed a lot of cash into people's bank accounts. And that is slowly dwindling away, which again, I think was a pretty
So people have spent.
People are spending that surplus money that they had. So that's a big thing moving forward, I suppose.
All right. Now I heard on the radio the other day that 2 out of 3 Australians have, if they were planning a holiday, they've put that on hold. If they were planning some sort of major expenditure, they've put that on hold. Is that is that the end result that the RBA was looking for?
It is to a degree. Ultimately, they're not out there to say, don't spend your money, don't go on holidays or anything along those lines. It's just that there was a massive amount of surplus funds available that people were spending. A lot of that to do with, interest rates being so low. It was so easy to get money, and even on a set income. And when you think about, repayment wise, a lot of people's mortgages have gone up $300 to $400 per week, but people's wages haven't gone up $300 to $400 per week, and that's where the stranglehold is, and that's essentially why they wanted to curb that inflation, so to stop the rates from continuing to go up, so they can come back down to see sort of an equilibrium. I guess when we look at the cash rate at 4.1%, the last time the cash rate was that high was back in 2008, just prior to the GFC.
Yeah.
So we did see at that point in time they did drop quite, and then it's been a sort of a fairly low consistency, and then what we've just seen over the last, I guess, for 13 months where we saw 12 rate rises, appreciatively we've had 2 rate pauses. I don't think we're completely out of the woodwork yet in regards to people who were talking to me today about, do you think rates are going to start coming back down? No, I think there still needs to be a steadying of the economy prior to we seeing rate reductions, which everyone is forecasting. Economists, banks, I was in a NAB forum and even a Westpac one where they were talking about what they were predicting, I guess, sort of 6 months ago, what they're predicting now, and what they're predicting in the next sort of 6 to 12 months. And they're all on the same page. They've all sort of said the cash rate they were anticipating to go to 4.6. So that was 2 more rate rises. I think we've skipped one. So I think we probably may only go to 4.35. But they're all, big news is they're all predicting 3.6 will be the cash rate at the end of next year. So, which is all about those rate cuts, which is what we're all looking forward to. So,
okay.
To see.
Well, that's good news. A bit of a clarification there from the RBA about what they think is going to happen. Now, every single episode we ask, obviously, our viewers to give us some feedback, tell us what they liked about what we're talking about. And amazingly, we got some feedback. What they did actually ask is, why would you not? We said one of our last episodes that neither one of us would recommend fixing our rates
personal loan
just right now. Me for different reasons to you, but a lot of the people at home are saying, well, why would we say don't fix rates? So do you want to jump into that one?
I can definitely elaborate a little bit more on that. Again, this is my personal opinion, but I can explain why I guess I've chosen to go down that avenue. I guess when we're talking about where the cash rate's going, so that's more to do with where variable rates lie. Fixed rates, we've actually seen fixed rates for most banks actually go up over the last sort of 2-3 weeks. So we've seen some banks lift as much as 0.6%. Some banks have only lifted sort of 0.1%, but they're all still lifting fixed rates. Now, the fixed rate market is to do with, I guess, long-term money making. So that's mainly for borrowing overseas versus borrowing from internally here in Australia. So with the fact that I guess 3-year swap rate is still increasing, means fixed rates will still increase. Now, when the bank actually lends you money on a fixed rate, I guess if you were to break that loan, so the question I guess I've been asked is, so Steve, if I fix now and then rates go down, I'm just going to refinance at a cheaper rate. And that sounds great in theory, except for the bank secured your money at this particular rate. So when the rates start going down, and which is what we saw through COVID, is you're going to get what they call as an economic break cost. So at the wholesale rate of what time they borrowed the money to what that rate's going to be when they sell the money back to the bank, they have to pay the difference between. So that's why when most economists and the RBA and everybody's talking about rates going down next year, I said I wouldn't fix because I would be too concerned about getting locked in and then having to pay a break cost in the future. So
that's been the complete opposite of what's happened. As rates were going down, okay, people were obviously they were in a situation where the bank would actively encourage them to break because they could obviously then lend the money at different rates.
Yeah, I guess it's more when rates are going up. So as rates went up, it's funny, they're going to charge you a fee to get out if they're going to lose money. But as they make money, where we've seen a few people actually break their 4.5% fixed rate to refinance on a 6% variable rate because they're doing debt consolidations and other bits and pieces.
Yes.
So they're actually borrowing at a higher rate, taking the loan over a longer period of time to reduce their repayments. So that's great for the banks because they don't give you any benefit if you break your fixed rate early when they're in the green. But what we saw through COVID as people were fixed at 4.5% and then all of a sudden rates went to 2%, we saw people getting $10,000 and $20,000 fixed rate bills. I can put my hand up. My fixed rate break cost was $11,367 for me to leave NAB to transfer my mortgages across to Members Equity Bank. And the big thing was I went from 4.8% to 1.89%. So, and my repayments actually dropped by sort of $600 a month at a much cheaper rate. But when I worked out that cost versus how much I'd save over a 3-year fixed rate, I was in front by about $17,000. So I guess I fronted the money up front,
which would hurt.
But I saved it over the long run. So
Okay, so what we're saying here now is we're being very specific. These are our personal opinions about whether you should or shouldn't enter into a fixed rate right now. Obviously, individuals would need to seek independent financial advice, which is obviously the prudent thing for us all to say. But you would need to make sure, based on your own personal circumstances, what's best for you. Now, there are going to be some people out there going to say, but listen, the reason I would think about getting a fixed term rate is because I physically have no more money, and if they continue to go up, I'm in big trouble.
And that's a big thing as well. And we are still doing some fixed rates for us at Stanford Financial. We're still getting
what sort of percentage of business would be people converting from variable to fixed, just as a rough guide? We're not going to hold you to it.
Less than 10%.
So less than 10%. And why do you think that is?
For exactly what you just said. I've just seen my repayments go from $1,500 a month to $2,500 a month, and if it goes then to $4,000 a month, if they double again, I'm going to have to sell, and I'd rather lock in now at $2,700 a month and know for the next 12 months, 24 months, or 36 months.
What your repayment's going to be?
My payment's going to be. Yes, I understand that the economy is going to move up and down, and I may be in a financially worse position, but the predicament I am in right now, this is the best for me financially and for my family. So they're things to take into consideration. And when we do offer, I guess, interest rates or finance packages, we always go, this is what your best fixed rate market is. This is what your best variable rate market is. This is the bank that has a combination of best fixed and variable. So sometimes it may not be, hey, I'm going to go to this bank because they've got the best fixed rate, but they may have a really high variable rate. And then you might only want half your loan fixed and half the loan variable. So it's then trying to work out which bank's going to be best suited for you. And that's why we always come to a lot of people with 4, 5, 6 bank recommendations, unless they just say to me, no, I just want a variable rate, or no, I just want a fixed rate. Then it makes it a little bit easier, because then we only have to recommend sort of 2 or 3 banks.
Okay, all right, good to know. So probably worthwhile, again, just telling the people at home, brokers like yourself have a obligation to put people in a better position than they currently are. So if you're going to refinance, you have to be able to prove that you've improved their position.
Yep. So it's called best interest duty. So it's only regulated by brokers. So banks aren't, I guess, required under the same guidelines as we are. So myself personally, or any sort of credit representative out there that's a broker, cannot put somebody into a worse financial position. We also have to make sure and I hate using the word cheapest, but we have to offer the cheapest loan possible. So what we mean by that is taking into, I guess, consideration of your personal circumstances. So somebody that's a first home buyer with 5% deposit versus somebody that's got an investment property and 50% equity are going to get 2 different interest rates, and definitely going to go to 2 different banks. So we've got to work out what, under your circumstances, which bank's best for you and which is the cheapest. And then that may consider interest rates, fees, charges, what we call as a revert rate. So if you do fix and you go, once your fixed rate expires, then the bank's going to put you on a set interest rate, which we always call it bank loyalty tax, where you don't generally get the same rates that are on offer. You're going to get whatever the rates applicable to you at that period of time. And we're seeing people come off these fixed rates at 8% through, I'm not going to name banks, but there's a couple of the banks out there aren't giving clients the best rate in the market when we're through the same bank, we're offering 5.8%. These clients are coming off at 8%, and that's not fair. And that's why it's always best to, I'm going to say call your broker and talk to them. So we do have a due diligence of the fact that we must be in contact with our clients and make sure that they're on the best rates as brokers. That's what we're supposed to do. Banks don't have to do that. They just put you on whatever rate. You can call your bank and try and renegotiate, or call a broker and they can renegotiate one for you on your behalf anyway, or to go through a financial overview and make sure that you are being financially savvy with your money and when put you on the best rate, or like we're seeing is a lot of people doing debt consolidations and these type of things. So.
Okay, so it's very important we basically let you know we're not bashing any banks in particular, but what we are saying is, obviously Stanford Financial, you're a brokerage in terms of you offer different products from different institutions. So and this is a real situation, people out there are struggling. So if you are struggling, talk to someone like yourself, who's a broker who can give you the best option and has to legally give you the best position possible.
Yep,
all right, quickly, we've got to wind this up. Mate, what is going to happen next month?
Oh, I'm honestly going to say flip of a coin. I guess Phil Lowe, who's the current governor of the RBA, steps down on the 17th of September. So this will be, next month will be his last RBA announcement. Now, it's not saying it's his sole responsibility to make that choice. Ultimately, he has a group of people, the board that does it. So I still feel that potentially that they probably will raise rates next month. And then that'll allow Michelle, who's stepping in as the new RBA governor, I guess to ease and go, all right, we're going to stabilize the economy for the next 6 months, and then we can then start look to drop rates. If they don't raise rates, if they don't raise rates next month, I don't think they'll raise rates anymore. And I think we'll start to see rate cuts middle of next year.
Wow. Okay. Well, look, I probably think we'll get one as well. I thought we would get one, this month, but that hasn't happened. So that's good news for everyone at home. But we could talk about this for hours, obviously. So once again, obviously, Steve, thank you so much. Appreciate your assistance, and obviously Stanford Financial coming along and helping us out every single month. Now, of course, for everyone at home, this is extremely topical. If you've got any questions, please just refer to the link below. Thank you for your previous questions. If you'd like to see more On the Couch with Steve, please tune in.